Peter, good to see you and have you join us. I got to ask, because you were fairly bearish coming into the fourth quarter, and
yes.
that's not been the right position to have. What do you think you missed?
Yeah, no, I think what we missed was really just momentum and sentiment. Markets get well overbought and they get well oversold. And, just as this time last year, we were having a conversation when the market was at 2,400 on this show. I saw no recession for 2019 and a rally off 2,400 and thought fair value was somewhere closer to 28 or 2,900. And that's been our position. And so while uncomfortable, for sure, this is reminiscent to me in terms of how stretched sentiment is of 1999. We have valuations that are really, really excessive by almost every measure. Price to revenue 2.3 times, enterprise value to EBITDA on the S&P at about 14 times. I could go on and on. We can talk about price earnings ratios on an LTM basis at about 21.5 times. The market did not have any earnings growth this year. The yield curve inverted, something we forecast. The trade war was prolonged, also something we forecast. All the conditions precedent to our caution in the second half occurred. But again, at times, sentiment overwhelms the sort of rational analysis that we're supposed to be doing as strategists. So what did we get wrong? We got sentiment wrong on a risks are behind us narrative. And by the way, listen to FedEx, listen to U.S. Steel. I can go on and on. Those risks, by my estimation, are not behind us.
So, Peter, what's the catalyst then for this pullback that you still expect, and how big a pullback do you think you could see?
Well, the timing, obviously, we have gotten wrong. And so exactly when it's going to happen, it is difficult to say how much longer this rally on sentiment lasts. Catalysts can be numerous. Sometimes it's what I call the weight of water, meaning people just kind of wake up to the fact that markets are pricing in a perfect scenario, which is exactly what I think they're doing next year. I think earnings, for example, will be a soft catalyst. Earnings expectations for next year are plus 10%. The market has completely looked through what is going to be flat earnings growth for this year. The market has rallied almost solely on buybacks and multiple expansion. So any hiccups in earnings in the first quarter could be one of those catalysts.
Charlie, you're clearly taking the other side of this.
Yeah, I agree with a lot of what Peter said, but the one area where I would disagree is I just think people are not excited enough about the economy. We're predicting a 3.2, 3.5% GDP growth. Since World War II, the U.S. has grown an average of 3.2% per year. So we're saying an inline growth rate, and the tailwinds we're going to have are we're going to have a better trade environment, we've got a stronger consumer, and we have a lot of the fears. American CEOs were very worried this year. They cut capital expenditures. I think they're going to be spending more money next year. So we are going to be modestly bullish on the economy.